Have you ever seen a bird that keeps flying into the same invisible wall? The cage door is already open, yet it never escapes. Not because it's trapped, but because after failing so many times, it begins believing the cage still exists. Many traders live inside that same invisible prison. Not because they only have a $100 account. Not because the market is against them. But because every trade is treated like the one chance that must change everything. That is where growth quietly dies. A small account doesn't trap a trader. It reveals one. It magnifies every weakness that a larger account can temporarily hide: impatience, oversized risk, emotional entries, revenge trading. And the addiction to making money quickly instead of building repeatable decisions. The market doesn't care how badly you want financial freedom. It only rewards behavior that can survive thousands of trades. In this journey, you'll discover why most traders stay trapped at the same account size for years, even after learning countless strategies. You'll see why more indicators rarely create better results. Why consistency is a mathematical habit instead of a motivational feeling. And why the traders who finally break through don't think differently because they became profitable. They became profitable because they learned to think differently. If a $100 account feels too small to change your life, then this story may change the way you look at trading forever. Because the account has never been the real cage. The mind inside it was. 1. The weight of one trade. Imagine carrying a glass of water with an outstretched arm. For the first minute, it feels effortless. After 10 minutes, your arm begins to shake. After an hour, even though the water hasn't become heavier, it feels unbearable. The weight never changed. The time you carried it did. A $100 trading account works the same way. The balance isn't what creates pressure. The meaning attached to that balance does. Many traders secretly assign impossible responsibilities to a small account. They expect it to pay bills, erase past mistakes, prove they are talented, and accelerate years of financial struggle into a few lucky trades. Every candle suddenly carries emotional weight far greater than its actual financial value. This is where psychology quietly begins to distort technical analysis. Instead of reading market structure objectively, the mind starts searching for certainty. A small pullback becomes a reason to panic. A strong trend becomes something to chase before it leaves forever. Every breakout feels like the last train. Every loss feels like personal failure instead of statistical probability. The chart never changed. The observer did. Technically, the market is a game of probabilities, not predictions. A high-quality setup does not promise a winning trade. It simply offers a positive expectation over a large sample. Yet traders with small accounts unconsciously demand certainty from a system that was never designed to provide it. That expectation changes execution. Stops become wider because accepting a small loss feels painful. Position sizes become larger because slow growth feels unacceptable. Trades are taken outside the plan because waiting feels more expensive than making mistakes. Ironically, the very actions meant to grow the account become the reason it never grows. Professional traders rarely ask, "How much can this trade make?" A better question is, "Does this trade deserve my risk?" That single shift changes everything. When every position must earn the right to receive capital, discipline stops feeling like sacrifice. It becomes intelligent capital allocation. The first breakthrough in trading isn't increasing the account balance. It's removing the emotional weight from every single trade. Because once one trade no longer feels responsible for changing your life, the mind finally becomes free enough to trade what is actually happening, instead of what it desperately hopes will happen. 2. Marco's turning point. Marco was an ordinary warehouse worker. Every payday, he transferred a small amount into his trading account. It wasn't much. After several months, he had finally built it to just over $100. He promised himself he would be patient. That promise lasted 3 days. The first winning trade made him believe he had finally figured out the market. He doubled his position on the next setup, convinced confidence was the missing ingredient. The trade failed. Instead of accepting the planned loss, he moved his stop farther away. Price continued against him. One mistake became 3. By the end of the week, half of his account had disappeared. Not because his strategy was terrible, but because his emotions quietly rewrote every rule he had created. For months, Marco searched for a better indicator. He downloaded new strategies, changed time frames, and blamed market makers, volatility, even bad luck. None of those were the real problem. One evening he opened his journal instead of another chart. He noticed something unusual. His profitable trades all shared one characteristic. They were taken after waiting for price to reach a clear level of structure, where trend, momentum, and risk aligned. His losing trades had something else in common. They all began with one sentence. I don't want to miss this. That wasn't technical analysis. That was fear disguised as opportunity. The next month, Marco made one decision that felt almost impossible. Before entering any trade, he forced himself to answer 3 questions. Is the trend clear? Is my risk already defined before I enter? Would I still take this setup if the outcome were a loss? If one answer was no, there was no trade. Something strange happened. His account barely moved for weeks. But neither did it collapse. For the first time, his equity curve stopped looking like a heartbeat and started looking like a staircase. The gains were smaller than he wanted, yet they stayed. The losses were still there, but they no longer erased months of progress. Marco eventually realized that consistency doesn't arrive when profits become bigger. It arrives when emotional mistakes become smaller. The market never rewarded him for trying harder. It rewarded him the moment he stopped trying to force tomorrow's profits into today's trade. 3. Daniel's quiet advantage. Daniel worked as a motorcycle mechanic. Every evening after closing the shop, he spent 2 hours studying charts. He wasn't lazy. In fact, he probably worked harder than most traders. Yet after nearly 2 years, his account still hovered around $100. One night, frustrated, he zoomed out on his chart instead of zooming in. That simple action revealed something he had ignored for months. Every losing trade had been taken inside market noise. Price was moving sideways, creating equal highs and equal lows, constantly trapping buyers and sellers. Yet Daniel kept convincing himself that every small candle was the beginning of a massive trend. His problem wasn't bad entries. It was impatience disguised as confidence. The market was ranging, but his mind demanded movement. From that day forward, Daniel created a rule that sounded almost ridiculous. If the market is undecided, I will be undecided. No trade was also a position. The first week felt unbearable. He watched several candles move without him. Fear whispered that he was missing opportunities. Then something unexpected happened. The breakout finally came. Price closed above a well-established resistance level with increasing momentum. Instead of jumping immediately, Daniel waited for the pullback to retest the broken level. The market returned, respected the new support, printed confirmation, and only then did he enter. His stop loss sat below the structure, not below his emotions. His target wasn't chosen because he wanted fast money. It was based on the next significant area where sellers had previously entered the market. The reward wasn't extraordinary. The execution was. For the first time, Daniel understood that patience isn't simply waiting. Patience is allowing technical evidence to replace emotional imagination. Weeks later, his account had not exploded. But something far more valuable had happened. His losing streaks became shorter. His winning trades became repeatable. Most importantly, he no longer felt exhausted after every trading session because he wasn't fighting every candle anymore. He was only participating when the market offered genuine asymmetry, small predefined risk with meaningful potential reward. Many traders believe success comes from finding more trades. Daniel discovered the opposite. The fewer unnecessary decisions he made, the fewer expensive mistakes he created. His account didn't escape $100 because he became fearless. It grew because he finally learned that the strongest edge in trading is often the discipline to do absolutely nothing. Until the market gives a reason to act. 4. The rusty key. Imagine standing before a locked door every single day. Believing that wealth, freedom, and success are waiting on the other side, you desperately search for a stronger key. Every week you buy another one. A new strategy. A different indicator. Another trading system. Another mentor. Years pass. Your pocket becomes full of keys. Yet the door never opens. Then one day, an old locksmith quietly walks by and says something unexpected. The problem isn't your key. It's the rust inside the lock. Most traders hear that sentence but never understand it. The lock is the mind. The rust is accumulated emotion. Every revenge trade adds another layer. Every oversized position makes it thicker. Every attempt to recover losses hardens it even more until eventually, even a good trading plan cannot move freely. That is why two traders can use exactly the same strategy and experience completely different results. One follows the process. The other negotiates with fear. The charts never know the difference. But the account always does. Many traders believe staying at $100 means they need more capital. In reality, that account is often acting like a mirror. It reflects habits before it reflects profits. If discipline cannot protect $100, it will never protect $10,000. Money doesn't repair weak behavior. It simply gives weak behavior a larger stage. This is why professional traders spend less time trying to predict the next candle and more time protecting the next decision. The quality of a trading career is rarely determined by brilliant entries. It is determined by ordinary decisions repeated with extraordinary consistency. A skipped impulsive trade. A respected stop loss. A patient wait while nothing happens. These moments look insignificant in isolation, yet together they become the invisible architecture of long-term profitability. Perhaps the greatest twist is this. Many believe the market is testing their strategy. Most of the time, the market is testing whether they can remain the same person after a win, after a loss, after boredom, and after temptation. The trader who finally escapes the $100 cycle isn't carrying a magical key. He simply removes the rust that kept the door from opening all along. The breakthrough was never hidden inside another strategy. It was waiting inside the discipline that had been neglected from the very beginning. 5. The way forward. If a trading account has remained around $100 for months or even years, stop asking how to grow it faster. Start asking why it refuses to grow. That single question shifts attention away from the market and back to the only thing that can truly be controlled: daily decisions. The solution is not another strategy. It is building a process that survives both winning and losing. Begin by reducing the importance of every individual trade. Risk only an amount that allows complete emotional neutrality. If one loss changes your mood, your position size is already too large. Next, measure success differently. Instead of counting profitable trades, count perfect executions. Celebrate every trade that followed the plan, regardless of the outcome. A losing trade executed correctly is still evidence that discipline is becoming stronger. A winning trade taken impulsively is still evidence that dangerous habits remain. Then simplify everything. Master one setup instead of chasing 10. Learn how it behaves in trending markets, ranging markets, and high volatility sessions. Repetition creates recognition, and recognition creates confidence that no indicator can replace. Keep a journal with complete honesty. Record not only entries and exits, but also emotions before pressing the buy or sell button. Over time, patterns will appear. Most traders think the chart is revealing their edge, but often the journal reveals their weaknesses first. Accept that consistency looks boring. There will be days when the best trade is no trade. There will be weeks where protecting capital is a greater achievement than making profit. Those quiet periods are not signs of failure. They are the foundation that prevents future collapse. Remember this whenever frustration appears. The market has no memory of yesterday's loss, no sympathy for today's struggle, and no obligation to reward effort. It responds only to disciplined execution repeated over hundreds of trades. $100 is not a verdict on your future. It is simply the classroom where patience, risk management, and emotional control are tested at the smallest cost possible. Graduate from those lessons, and the account will eventually follow. Because profitable traders are not defined by the amount of money they begin with. They are defined by the person they become while protecting every dollar they already have. If you found value in this video, take a moment to like and share it with someone who needs this reminder. Subscribe if you're serious about building the mindset, discipline, and skills required for long-term success in trading. More powerful stories, practical lessons, and trading psychology insights are on the way. Remember, success in trading isn't built by one perfect trade. It's built by thousands of disciplined decisions. Stay patient, stay consistent, protect your capital, and keep moving forward. I'll see you in the next video.